Welcome to another episode of the Money Printers Podcast. I'm your co-host Tola. I'm here with my billionaire brother Dame. Billy boy, how you feeling today, man? Everything good?
My billionaire brother, I'm feeling amazing, golden, godly. How you feeling, my brother?
Feeling abundant, my billionaire brother. I'm feeling amazing. Feeling nice and healthy and wealthy.
You got the Bruce Leroy glow. You know what I mean?
You already know. You know how that light hit.
I already know. That's good energy.
You already know, my brother. That's a good shirt you got on, man.
That's an amazing shirt that you got on, man.
That's right. You know, the Money Printers.
I don't have that.
The brand.
Sure. I need that. You holding out on me. You holding out.
I got you, bro. I got you. So today we're going to talk about options. As you guys know, we do trade options in the stock market. And we thought it would be good to give you guys a nice little snippet or intro to options and how it works and some definitions. So let's get into it, right? We're going to first get into how we got started. So Dane, how did you get started with options trading?
Man, it was a dark and stormy night. Wind was howling, so during the pandemic, when the pandemic first started, around like March or April, I was on Instagram, social media, and I'm just seeing posts of people turning like $30 into thousands of dollars. And I'm like, you know how you just keep seeing something, you're like, all right, it's fake, it's too crazy, right? Yeah, you're ignoring it. But you just keep seeing it, So I just kept seeing it. And then finally it was like, all right, I was home around like May or June, from my job at the time. And I was like, you know what? Let me just see what this is. So I saw a course online. It was relatively inexpensive. It was like $50, $60. And I'm like, all right, worst come to worst, I'll learn something, you know what I mean? Or, I'll see what this is about. Like it's $60, Not to say it ain't $60 anything to sneeze at, but it's like, it's $60. What's the worst that could happen? And what that did was, the course was basic, but it exposed me to what was possible, what I did not know. And I'm like, oh, wow. So from there, it was like, okay, I just started deep diving on Google, YouTube University. And, if you're not on page 25 on Google, you ain't going hard enough. You're not looking. So
are you really researching if you ain't on page 25?
If you're on page 35, you got a whole bunch of click links. Like, I seen this already. So are you really researching? So yeah, I just completely immersed myself, me being home, not being able to go to the gym. I'm a avid workout person. So it's like, I love working out. So it's like, I had to replace me going to the gym with, education and doing other things. So I just completely immersed myself in learning how to trade, learning everything about options. So how did you get started?
Come on, man. So I love your dark, stormy night analogy because it actually was a dark, stormy night. Like it was the pandemic. Things was really dark for people. You understand? And at the time, it was definitely dark for me, So what had happened was I had lost my job, actually. And I had ways of making money. But at that moment, it was like, okay, my number one, one of my streams of revenue is cut off right now. So how am I going to make money? So I had asked somebody, hey, can you teach me how to trade stocks? And that person wasn't able to teach me how to trade stocks at the time, unfortunately. So my billionaire brother, the one that I'm looking at right now, Billy Boy Dame, the GOAT, that option course that he talked about, he actually sent it to me. And that was a game changer right there because that option course, I don't want to say that it was an eye opener. That's all I'm going to say. But it made me go down a rabbit hole. And it took me, I watched it maybe like 5 times and I just couldn't get past like 30 minutes. I was like, man, this thing is like, it's something else. Like, it's a lot, it's like going back to college again. And it took me down a rabbit hole. Like Dame just said, if you're not on page 30 of Google, are you really really researching, I was on like page 50 of YouTube, and I was just going through videos and videos and videos and just immersing myself in so much information that I just started getting great at it. I started to understand what I was looking at as far as the charts and understanding the lingo. And that's how I got started into trading options.
I like that you said that. And that's one part that I left out is it did take me a little bit to get through that course as well. Because I was like, not only, with just life and everything in general, it's like, all right, I'm gonna try to watch 30 minutes here. Before you know it, it's like, all right. So like 3 weeks go by, 4 weeks go by, you're just not consistent. And then finally, like I said, around June, like, you know what? Let me just knock all of this out. Let me just be consistent. Let me completely lock in and immerse myself. It's like I'm seeing a potential. Like I said, I'm home. Let me just lock completely in and see what comes of it. And that's how the money printers were born. So
that's how we formed. Like, but I think we should talk a little bit more about that, because it was more about how we were born, right? We started to post our gains and stuff like that on the internet, on social media, and people started to take a liking to it, or just like, I guess it was like mysterious. Like, what is this thing? Why is everybody posting this? Like, what is going on? And we made a group chat, and the iMessage wouldn't allow any more people in the group. And Dame was like, bro, let's bring this to Slack. And I was like, it's like, okay, yeah, like, I don't know how it works, but let's do that. I like that idea. And Dame just started working his mental. I was like, my man is a genius. All right, let's do this. So, we had our community. It was like free for about a year. And then we started to charge a little bit, a little something. And from there, we just started to keep on growing. Now we have the mentorship program, and we're helping people build over 6-figure accounts. So there's a lot that we've been doing, and we're going to continue doing more. We're just getting started. So I just wanted to tap into that. But, a little bit backstory of how we got started.
Yeah, that was good times, because it was just me and you just texting, sharing information. Okay, YouTube videos, jumping on calls. And then we added a third person. And then I tell this story all the time, but one day I woke up and it was like 31 people in the chat. And I'm like, I have no idea who any of these people are. I was just mad random New York numbers. Like, I have no idea who it is. Like New York, it was a couple of like DMV numbers. I'm like, yo, bro, let's take to this messaging platform.
It's crazy, because now we got people all over the world.
All over the world that's tapped in with the money printers. And like you said, building generational wealth, helping people, change their life. And one thing about options is it's very powerful. Options do give you options. Sometimes it sounds cliche, but options give you options on what you can do. Right? We have a lot of people that are retiring from their 9-to-5 at young ages. Some as young as 21, 22. Right? We have a significant amount of millionaires that we've created, or we've helped to create in these last, couple of months. You know what I mean? So it's very, very powerful, but you're going to get out of it what you put into it. So, what exactly are options? Let's get into that. So options are contracts, okay, that allow traders to control 100 shares of stock. All right. So you don't own it. You only control the shares until the expiration date. All right. So each options contract that you purchase, you have an expiration date that you can purchase. That is called the premium. The premium is how much you pay for each one of these options contracts. So the further out the expiration, the more you'll be paying for these option contracts. It's like you rent a car. If you rent a car for 24 hours, you're going to pay a lot less than if you rent a car for a whole 30 days. 30 days. Right? Anything you want to add to that?
Yeah, so those option contracts, they usually expire every Friday. You have weeklies that expire every Friday. And then you have those ones that expire every third Friday. And then you have option contracts that expire every day. Now, the ones that expire every day is usually SPX, QQQ, SPY. Those, I think SPY. I know SPX definitely has every day, right? So those have every day expiration. So meaning that if you buy the contract today, you can exercise it or sell it for a win or loss on the same day. So with any option contract, you have the choice to sell whenever you feel like it, whether it's for a loss or for a profit. So even if you bought an option contract that expires in 2 years, you can sell that if the stock goes up $20 today and you make $20,000, you can sell it for profit, even though it still has time on it. And that's totally up to you and totally up to how you manage your risk. So
Absolutely. Yeah, so SPX expires every day.
Every day, yeah.
SPX is the S&P, and we have SPY, SPY, and QQQ. Those expire 3 times a week. So those expire Monday, Wednesday, and Friday. All right. So the difference between options and stocks. All right. So with the stock, you actually have to own the share. All right. So you'll purchase the shares, whatever the share price is, you would own that until it's time to sell it. So with options, again, you just control 100 shares of stocks. You never own them. But the beautiful thing about options is, you can make money whether the stock market goes up or the stock market goes down. When you own shares and when you buy shares, you can only make money when that stock goes up.
Let me add to that. So like Dame just said, you can make money as the stock goes up and you can make money as the stock goes down. So if you want to make money as the stock is going up, you can buy a call. A call is basically just stating that you believe the underlying stock is going to move in an upward direction. So say, for instance, Apple is trading at 150 and you believe it's going to go to 155. You would buy a call because you believe that the stock is going to keep on going up to 155. And as that stock is increasing, that premium that you paid, that Dame mentioned before, that premium that you paid is going to increase in price. And that difference from the price that you paid to the price that it is now as it's increasing is your profit. Okay, so you can either buy a call or a put. Okay, now if you're buying a put, you believe that the stock is going to go down. So again, same thing like a call, but just in reverse or an opposite. So if let's say Apple is trading at 150 and you believe it's going to go down to 145, a $5 move to the downside, you would buy a put and you could capitalize on either one, whether it be a call or a put. Now, this is a little analogy for people to, make it easy for them. When you pick up the phone or you pick up a call, you pick up the phone and it's right. You call up and you put down, right? So you put down the phone and when you have a call, you pick it up. So up, put down.
So when you're purchasing a call or a put, what you're going to be purchasing with this options contract, you're going to be purchasing something called a strike price. Right? Now, the strike price is like in baseball, you throw a strike, in bowling, you throw a strike. That's what it is, a strike price. So this strike price is the price that you believe the stock can reach by the expiration date. So that analogy that Tola just gave with, let's say Apple is at 150 right now. If you believe that Apple can reach 155 by a certain date, you would buy a $155 call. Okay, $155 strike price and a call. You believe it's going to go up. Okay, now with that, the stock doesn't have to reach the strike price for you to make money. Okay, and that's another beautiful thing about options. So as long as it's moving in that direction of the price, your strike price, then you can make money. All right.
Disclaimer, though. Disclaimer.
Yeah.
Not all contracts or all strike prices are going to make money. Now, it has to be realistic, right? Now, a $5 move on Apple is possible, right? Apple can move $2, $3 in a day, and you can make money on that contract. But let's say you wanted to buy a 250 strike price, and Apple is trading at 150. That's $100 away. And let's say it expires in a day, or the next day, or even next week. You have to look at the trend of Apple and how it moves. That's not its mannerisms, right? So it may move only $5 in a week, $10 in a week at most, right? So $100 away, and the strike price is too far out the money, meaning that, this is 150 and 250 is like all the way over here. So in order for it to reach 250, $100 move is going to take a lot for Apple to do that. You understand? And that's not its tendency. So that may not print the same way as a 155 contract may print, because 150 and 155 are very close to each other. But 250 is like way too far out. You understand? And we have something called deltas. Deltas is what pays you. So the further you're out and the closer you are in date, the less is going to print. Okay, so let's say you have a 250 strike price, your delta is probably going to be 0.00. So what 0.00 means is every dollar move, you're going to get paid $0. Okay, now let's say you moved in to 155, right? 155 strike price. That delta may be 0.50. So 0.50 means $50. You're going to get paid $50 for every dollar move. Okay, so 0.50, you're always going to multiply it by 100, because again, you're controlling 100 contracts at a time. So 0.50 times 100 is going to give you $50, and every dollar move that Apple does, you're going to get paid $50, right? So if it moved up $2, how much money do you make? You guessed it right, $100. If you bought the 155 strike contract. All right. So you got to make sure. That's another thing that a lot of people miss. And a lot of new traders, they lose a lot of money because they're buying contracts that are out the money and they're cheaper, and they lose money because of that. My bad, Billy Boy. I just had to add that.
No, I love that disclaimer. Again, it has to be a realistic strike price. If the stock has never ran over a certain amount in a day ever, buying a contract that's super far away is just not going to work. And you're basically throwing money away. So you mentioned something that was interesting that our listeners may not know. You said out the. So could you give us what out the money is, in the money, and at the money?
Yeah. So you got out the money, in the money, and at the money, right? So let's think of it like this. In the money means that the price has already been surpassed. Okay, so if you're buying a 150 contract or a 150 call, everything underneath that has already been surpassed, and that's inside of the money. Okay, so 150, 149, 148, down to $1, right? Those are all in the money. Everything that the price has not reached yet is out the money. So if you're at 150, 160 is out the money, 170 is out the money, 155 is out the money, 200 is out the money. That's out the money because that price hasn't reached yet. You understand? Now, everything that's at the money is basically everything that's trading around that price. So if you're at 150, 155, 145, that's usually like at the money. Okay?
Okay. So if something is out of the money, right? How is its value determined by versus something that's in the money?
Right. So it's time and volatility, right? That's really what's going to give you. That's really what's best about those things that are out the money. Well, not best, but if you have time on your hands and you have volatility, those things can work in your favor if you have out the money contracts. So let's say you have something that expires in 2 to 3 years. And let's say that Apple trends for 2-3 months and it's going up, and it may have went up $25, $30, right? Those out the money contracts, due to that volatility or that movement up and down, it can print money. And the fact that you have time is also a good factor, because you're basically not expiring anytime soon. Now, if you have something that's in the money, right? You have that intrinsic value, and that's basically saying that, hey, you pretty much have power because the price has already surpassed. So you're kind of like in the safe zone, so to say. What you think, Dane?
No, I love that explanation. So intrinsic value is determined by how far in the money the contracts are.
Right.
Extrinsic value is basically just time and volatility. So with options, when something is out the money, it's like potential. Okay, so if you see somebody, you're like, you may fall in like or fall in love with their potential. So it's like, oh, you have the potential to do this. So with options, that's a great thing. All right. So you're like, all right, you can potentially hit this. Okay, you were already at this level before, so you can potentially hit this again. Okay. So that's where a lot of the value comes from on out the money contracts, that potential, that extrinsic value. Okay, so out of the money contracts are typically a lot less expensive than in the money or at the money contracts. Again, because it's that potential, right? If they do have potential to get in the money or at the money, but because they out the money, only thing that they have is potential.
There's a lot of hopium within that potential.
Yeah.
So we like to use the word hopium, right?
Mhm.
And we don't want people to rely on hope, right? Because hope is not set in stone, right? And as far in this market, as far as this market goes, you can have all the hope that you want, but if the market doesn't want to do that, it's not going to do that, right? So there's a lot of hopium that lies in out of the money contracts, especially ones that are not realistic, right? So, again, I'm going to use this analogy again. If you have Apple is trading at 150 and you're buying $200 calls and it expires the next week, it's like, what is the likelihood of that happening, right? So you got to think about that. And again, a lot of traders, they rely on hopium, like, oh, this could possibly happen. It's possible because I've seen it happen with this stock and that stock. Well, that's the characteristics of that stock and this stock, but not this stock. You understand? So there's a lot of hopium that lies within that. And once you understand the characteristics, then you'll be a better trader. You just got to identify the stocks that you're trading, right? Every stock has a different kind of personality, right? So a lot of us, we date, right? We date our ladies, we're married, right? And it's only one person. That's only one personality that we got to deal with. But for those people that are dealing with 10 people, 20 people, right? You got to deal with 20 different personalities. It's hard to juggle that. You understand? So this is why we always tell people, hey, look, just try to trade one stock, marry that stock, understand how that stock moves up and down. So you won't be buying those unrealistic prices. You'll know, okay, I know that this stock can only reach this price and it may drop from there. And you just make better choices that way.
Absolutely. And that is an amazing analogy with, dating multiple people. It's like your attention is divided into so many different places, but, when you have that one person, it's like I can focus all my time and attention on this one person. So, and I always ask people, if you get 100% on Amazon or 100% on Tesla, or 100% on QQQ or SPY, which one is more? Like,
and they always stumble.
right. Is it Amazon? It's like 100% is 100%. Yes, a lot of people fall in love with the sexier names, but a lot of these companies, if you can have something that prints 100% consistently and you know the characteristics, you don't need to chase 5 or 10 or 15 other companies and try to get to learn how they move here and do this and do that. So, stick with a handful of stocks, again, 1 or 2, learn how they move and just make your money. And I think with the hopium you touched on, some of the contracts that we trade, they do go from, we call it from Pookie to Penthouse, right? So you guys don't know, Pookie is a character from a classic movie, New Jack City. And a Penthouse, it is what it is. So when we say that, contracts that we trade sometimes can go from, 30 cents, which is $30 to, $3,000 in a matter of, a few hours sometimes. So a lot of people see that and they want it to happen on an everyday basis. And it's just not like, it's not going to happen every single day. Now, it does happen often, but not every single day and not with every single stock. There's only a handful of stocks where
That'll move like that.
The penthouse is possible. Right? So
Spooky the penthouse is really hilarious.
pure comedy. So what would you say is your top 2 to 3 stocks to trade?
SPX, QQQ, and Tesla. Yeah. I like the way that they move. I like the way SPX moves. It moves similar to how Tesla moves, and Tesla, if you've traded it long enough, it's kind of predictable in a way. And then QQQ, I like the way that moves. It mirrors Apple, so we know that if tech is dropping, we know that QQQ is going to be dropping, because QQQ is basically the basket holder or the ETF of tech companies. So we know that if it's going up, if Apple's going up, Microsoft is going up, we know that QQQ is going up. So it's very easy to basically trade it, just by looking at those little basic nuances.
I like that. So Tesla, QQQ, and
yes. Yeah. How about you, my billionaire brother?
Come on. That's my QQQ is, man.
That's your baby.
QQQ, SPX, and TQQQ.
Ooh, TQQQ. They don't know about that.
Yeah, so TQQQ is a triple leverage QQQ. What triple leverage is it means, or it seeks to return 3 times the profit of the ETF that it's. So I love TQQQ.
Ooh, that's a goodie.
Yeah.
TQQQ is a nice one to trade in options because it's cheaper than QQQ, and it basically moves the same, and you could basically get the same return. Like Dame said earlier, 100% on TQQQ, you get it on, QQQ, and TQQQ is the same. So why not pay cheaper, buy more contracts, possibly print more money?
Absolutely.
I like that. It's a good one. Good one. So quick question, Dame.
Yeah.
What are some options, do's and don'ts that you got?
Option do's and don't. Do, take your profit. No.
Number one,
take your profit. So that's a good question. Some option do's are learn first. We see a lot of people that, they see the gains, they see the profit, and they just want to come in and like, all right, I don't need to study, I don't need to research. I'm just gonna come in and let me just throw my money in it. They treat it like it's a game, like it's kind of a gamble. I'm just gonna put my money on black and close my eyes type thing. And that's not what you want to do. So first things first is you want to learn. You want to learn as much as possible. And even before that, you want to create a plan. Like, what is your why? What is your reason for wanting to print money? What is your reason for wanting to trade options? Because on days that may not go your way and you may want to give up, question yourself, your why is going to push you through. So create a plan of your why, create a plan of what your identity would be. And we didn't talk about identities, but when it comes to trading identity, there's a few different identities, but it's all based on your personality. It's all based on your lifestyle. So I'll give the identities real quick and then I'll get back to answering that question. So we have a scalper, which scalpers are, they're making a lot of trades sometimes, and they are in trades from a couple of seconds to a couple of minutes. Okay. Mm-hmm. We have day traders. Day traders are going to be in contracts and hold them for up to a day. Swing traders, they're going to be holding the contracts overnight. So for at least one day. So a swing is, I'm holding it overnight for at least one day, up to a few months to a year. And then we have leap traders, right? So, leaps are longer contracts that expire, 1 to 3 years. Okay. So based on your identity, your personality, your lifestyle, which you got going on, you will develop an identity. Now, some people are all 4. Some people are 2. Some people are just 1. So you want to have an identity of how you're going to trade, what you're looking to do, what you're looking to accomplish. You want to set a roadmap. before you even jump in this thing. So that's the first thing that I recommend to do. What are some do's for you? Then I'll get into the don'ts.
Okay. I always tell people, learn before you earn. You don't go into any job, any high paying job without learning what you got to do first. So learn the ins and outs. Learn what a delta is. Learn what a call and a put is. Learn how to read the charts. Paper trade, right? Paper trading is trading on fake money. Paper trade first, because you don't want to get in there and start losing your real money. A lot of y'all work really hard for your money, and to put it into the market and lose it, it could really hurt, and it could be very discouraging. So learn before you earn. Paper trade. What else? Journal, right? Journaling is big. A lot of people don't journal, but just journal what you've seen in the market. Journal what was right in the market, what was wrong in the market, what was right with your trade, what was wrong with your trade. Is going to help you become a better trader. So I believe, journaling is definitely going to help you a lot. Like Dame said, take profit. I always tell people, get in, get green, and get gone, right? Get in, get green, and get gone. Like, I can say it again. Get in, get green, and get gone. Like, because a lot of y'all see profit and y'all don't take the profit. Y'all see 20%, you're like, I'm not taking that. That's not enough. I see 100%, I'm not taking that. That's not enough. And you got to understand that this is a compound game. It's not a race. It's a marathon. You understand? So compound is like huge. Once you start to compound your money in this game, you could become a millionaire like this. You understand? So those are my dues. And I don't think I have any others.
We joked about
risk, and manage your risk. Manage your risk. Set a stop loss, right? Even if it's a mental one, know that, hey, look, under this level, I'm getting out. All right.
The level's a price point for you guys that understand. So if it goes above a certain level, depending on if you're in calls or puts, that's how you know I'm going to get in or get out. But we joked about that earlier in the community that, somebody was like, I guess I'll just take this 70%. Right. So
it's rinky dinky 70%.
Yeah. So I mean, in our community with the way we trade and how we understand the market, we're very fortunate enough to see some high percentages. So,
every day.
Every day. Certainly a bunch of times throughout the week, but it was a joke that one of our billionaire brothers and sisters made in the chat, like, yeah, I guess I'll take this 70% because they're so accustomed to a lot of things going 100%, 200%, 300% that, sometimes when we see a day where we get in like 50% or 70%, they're like, I don't want to say spoiled, but they're like, all right, what's going on here?
Right.
I guess, like they said, we do have them spoiled. We do have them, everybody's well equipped to handle the market and know how to attack and approach it. So that's a great thing. But also, just understand that 20%, 30%, 40%, 50% in a day, those are still amazing numbers. 50% in a day, that's like for every $100 you put in, you're getting back 50.
Right. So my thing to those people that are looking at 70%, 50%, like, ew, I'm not taking that. Go to your bank statement right now and tell me how much the bank's been paying you for the past year. Right? The banks don't pay you nothing, and you leave your money sitting in there every single day. So if you can make 50% of return on your money in one day, sometimes in 15 minutes, 5 minutes, like in one candle, you got to be grateful, right? And I think that's another like important part. You got to be grateful about the money that you're able to make in this market, because a lot of people don't know about it. A lot of people aren't, they're not privy to what they can do in this market and how it can, give them more options in life. And, you got to be grateful about these things. And when you're grateful about it and you feel blessed about it, more blessings will come to you. But I don't want to get into no, I don't want to get into that.
No, I mean, I think we can, because gratitude attracts more of what you want. Because if you're not grateful for that 70%, and you're just sneezing at it, that means you're not gonna take that 70%, right? So gratitude is gonna just keep attracting those 70% plays. And it's like, all right, you're grateful for this, okay. Let me give you another 70%. You just compound. So, but that's the psychological part of being in a market. It's like, all right, I'm grateful for just a green day. Right. Sometimes if you're just grateful for a green day, the next day may be a crazy day.
Right.
You know what I mean?
And trading is like 90% psychological.
Right.
You know, once you understand that, you know, and you got your mind right, you could print a lot of money.
Absolutely. So what are some don'ts?
You were supposed to answer that. I got you though. Don't do everything that I told you not to do. So don't not journal. Don't not. But you get what I'm saying. All right. So basically, for those people that are not learning, blindly trading, not charting, not asking for help, you know, asking elevated questions, those are things that you should not be doing. You need to be asking questions and you know, charting, understanding, and constantly learning, because the market is constantly turning and the world is constantly turning. Things are, you know, always changing around us. So for you to be ignorant in this market can really be your downfall. You understand? So just making sure that you're always learning, always progressing in this market, and just doing the things that I told you to do. I think that would definitely help you a lot.
Absolutely. Don't not. That's funny.
Don't not.
Yeah.
Yeah.
Don't get into a play that you haven't charted or that you haven't looked over or done your own due diligence on, right? Don't let other people's opinion sway you from something that you believe in. And this not only applies to the stock market, this statement, this applies to life in general. If you believe something and you have like actual data and things that can prove it, believe in your play, believe in yourself. Because there's nothing more annoying sometimes than there's a play that you believe in and you think, yo, this play is gonna hit. I charted it up. I looked at the fundamentals. I looked at the technicals. Everything looks like it's going great. And somebody's like, nah, man, it's not gonna do this. And you're like, all right, cool, yeah, I'm gonna listen to you. And then your play runs to the moon. Your play goes 1,000%. And you're like, damn, you know. So always listen to yourself. Don't let others' opinions sway your opinion, especially when it's backed by factual data, the work that you've done. And it's easier to live with if you have a lesson that you learn, you know what I mean, based on your own, you know, your own doing, as opposed to you listen to someone and you're like, you know what, I shouldn't have listened to you. Those lessons are always better when they come from, you know, yourself, because they'll stick with you.
Right.
More than that. So.
Yo, you brought up something about like how, you know, you put it on black on roulette and just close your eyes.
Right.
And, you know, there's a big misconception that being in the market is a gamble. And can you just get into that real quick about how being in the market or just trading options is not gambling, is not the same as gambling?
This conversation is like, it's a little bit, I don't want to say bothersome, but it's like, all right, you can kind of see why people think that it's gambling when you don't have the knowledge. But when I tell people, all right, if you gamble, whatever money you put down, you're either going to win or you're going to lose. So if you go to, you know, a table, a poker table, any kind of table, whatever, to gamble, if you put down $100, you're either going to win whatever or you're going to lose whatever. You're not going to say, hey, I'm going to put down $100 and then take a 20% stop loss, you know, if this doesn't work out. So when you're trading, if you enter a play or you enter a position, if it drops below a certain level or you hit a certain percentage and you want to take what's left, you can take your money out at any time. So if it drops 10%, you can take the 90% capital you have left. If it drops 20%, you can take the 80% capital you have left. All right. If it goes up 10%, you can take your 10% profit. If it goes up 20%, you can take your 20% profit. when it comes to gambling, you can't put money on the table and say, you know what, it's fun enough. I'm gonna just take this 20% profit, or
Nope.
how about this? I'm gonna take this 20% profit. You can't do that. And that's one way that trading and gambling differs. How about you?
No, that's a fact. I think what did I want to add to that? All right, so basically, there's also another disclaimer. Just because it went down 10%, don't mean it can't go back up another 10%, right? If you gambling at the roulette table or wherever, like he said, it's either 50-50 chance. You either win or you lose. Now, sometimes stocks can go down 10% and then it can start going up 50%. So what happens? Now you're up 40% on the day, right? So you could go down 10% and then it could go up 100% or whatever. That's how options are. It can either go up, it could go down, because options and stocks, they just go up and down all day and it fluctuates, right? But you got to know when to cut your losers, and that's how you preserve your capital. It's all a game of compounding, preserving, and also just playing, not playing defense, but just understanding when, okay, enough is enough, when to get out and to, call it quits for the day, whether it's for the day or whatever, right? But you got to preserve your capital. That's like number one thing. If you don't have money, how are you going to trade? Right? So you can't let trades go down 100%. Now you're not going to have any money. Right? And then risk management. You're not going to trade with 100% of your money. Right? So let's say if you did happen to let a trade go down 100%, at least you still have reserve on the side. Right? So if you have $500, so to say, right? Maybe you want to trade with 20% of your money. Right? Break it into sections. Trading with 20%, okay, you have $100 that you traded with. And, let's say if that goes down 25%, you say, you know what, I'm enough, that's enough. You still have $75 left over to trade with that money, right? So now you have $475. My bad. Yeah, $475, right? Is my math right? Right? So if it goes down 25%, you still got $475 to play with. If you're trading with if you're gambling in Vegas and you put that $100 in, and let's say you lose, now you only have $400 left. You understand? So that's the difference between options and gambling. You could actually preserve your capital and live to trade another day. If you're gambling, it's either win or lose. If you hit, that's good. Shout out to you. But if you don't, you ain't seeing that money ever again.
You leave more things to chance.
Right.
We rely heavily on, our technical analysis and patterns and things like that for us to see, for us to get in and get out of plays. And that's a great point. I never thought about that when you said, okay, it can go down 10% and then shoot up 60% or 100% or whatever. Sometimes you don't have the perfect entry, where as soon as you get in, it runs up 100%, you're able to get out. Sometimes you're going to go up 3% and then down 4% and then up 10%, and then you may be even, and then it takes off, right? So that's another great point, is that, it may be some turbulence before takeoff.
That's a fact.
Like that.
That's a fact.
I like that. So, what can you talk about the importance of risk management? Like, I know, we touched on it in there, but the importance of risk management.
So risk management is like the number one thing, right? Risk management is like insurance, right? You're not going to drive your car without insurance. Some people do, but it's risky, right? That's risk management. Okay, yeah, I got into an accident, all right, but my insurance is going to cover it. Same thing with risk management. You get into a play, let's say you pay $200 for that play, and it starts to go against you. You have to have risk management in play to say, okay, look, if it hits this certain level, or if it goes beneath this price, I'm cutting my loss and I'm preserving my capital. So it's like the number one thing in trading. You got to have risk management. Without it, you could easily blow your account, AKA lose all your money, right? You don't want to be that person that's in the shower on the floor, shaking and crying because you lost all your money, right? So you got to preserve your capital And the best way to do that is with risk management, putting a stop loss in place, whether it's a hard one, a mental one, a trailing stop, whatever, right? And we can get into that later on in another podcast, but you have to basically, you have to manage your risk. You can hedge, there's a lot of ways that you could do these things.
Mm.
What you think?
I agree. Risk management and psychology are two of the most important things, because like you said, understand that if you have, let's say, a $5,000 account, if you're going to put the whole $5,000 into one play, that's not risk management.
You're not managing your risk properly. Yeah.
Right. Like Biggie said, you want to break it down into sections. Okay. So if you have 5,000, you may want to only put 500 on a play or 1,000 on a play, and then break up your money. It's like, okay, so if you have, if you put $500 on a play, and then your risk says, I'm going to cut my loss at this level or 20%. So you're using 10% of your account, and then only 20% of that 10%. So that's 2% of your overall account. So if the play goes down, $100, so you still have $4,900 left to play with.
Yep.
From a $500 account. And then a $5,000 account. That is how you manage your risk. You want to have strict risk management. I'm going to enter this level. I'm going to exit at this level. I'm going to cut my loss at this level. Entry, exit, stop loss. You want to have rules in place. All right. This is a business. If you treat it if you treat it as a hobby, it's going to be a hobby. You're going to get up and down results. But when you treat it as, I'm a businessman, this is how I'm growing my business. I have rules and regulations in place. This is how you grow your account. Speaking of business, we're going to give y'all the business aspect on it, on our next episode. So it's tapping into the psychological of it. It's 90% psychological, because it's you versus you. It's you versus your perception of the market, what you're seeing. The market just presents opportunities for you to make money. So it's, what am I seeing? Am I perceiving this correctly? A lot of people feel like the stock market is out to get me. The stocks, this and this and that. And yes, of course, the job of the stock market is to provide liquidity, is to make money. But how you perceive the market is what causes you to either make or lose money. So if you perceive a potential opportunity, right, you want your risk to reward ratio to make sense. So you want to at least a 1-to-3 or 1-to-4 risk to reward ratio, meaning that for every $100 that I put up, I want to at least make $300 to $400.
Right.
So, that's psychological. And again, the psychological aspect is, am I disciplined enough to only enter and exit trades based on my rules? I'm going to ignore everything else. If I say I'm going to enter here, am I going to be patient enough to enter at my level? Or am I just going to jump in because, I'm scared it's going to take off, or this and this and that, or, I don't want to miss the train? Or am I going to exit too early because I'm scared I don't want to lose money? Right. That's the psychological aspect of it. So risk management and psychology are very, very important.
That's a fact. That's a fact. My billionaire brother, man, dropping the gems today. Thank you.
Come on, for sure.
Love this.
Can you drop some brokerages?
For sure. So we got our number one platform that we like to use, TD Ameritrade, aka Thinkorswim. You have E-Trade, you have Robinhood, you have Webull, you have Fidelity, you have TradeStation, you have Robinhood. So and then of course there's other brokerages like, I'm sure Chase, they have their own little brokerage that you could trade under. So those are the ones that we pretty much know about, and the ones that we use. But for the most part, TD Ameritrade, Thinkorswim, I love that platform. It's a robust platform, but it basically helps you trade, get in and out quick. And there's ways that you could basically not trade on margin. Margin is basically borrowed money. You could trade on a cash account. So there's a lot that you could do with TD Ameritrade, Thinkorswim. This is not an endorsement for them, So just wanted to add that.
Definitely. Yeah. Okay. So we got TD Ameritrade, we got E-Trade, Fidelity, Tastyworks, Webull, Robinhood. You gave a lot of good platforms.
Money printers. If you're looking to learn how to invest in the stock market by trading options, look no further. The Money Printers community is filled with skilled traders helping you make money and navigate through this market efficiently to help you reach your $1 million floor. If you're looking to join us on this wealth building journey, click the link below. Peace.
Okay, so we got a bunch of brokerages. All right. Is there a specific time of day that you prefer to trade, or does it matter on your trading style?
Yeah, so I really love trading during the high volatility, high volume hours. So what do I mean by that? 9:30 is when the market opens till about 11:30, maybe 12. And then there's like a pause in between that time that I don't like trading at because there's a lot of chop, there's a lot of low volume going on. And so from that time, I don't like to trade. And then you have power hour, which is from 3 p.m. to 4 p.m. Those are the times that I usually like to trade. And then you get those times where the feds are speaking. They usually speak around 2 p.m. I like to trade around that time as well because you can catch a nice pop or a nice drop or whatever, a nice little move when they're talking. They kind of, I don't want to say manipulate the market, but they know how to move the markets when they talk. So you can catch a lot of nice volatility moves when they speak. How about you?
And just to be clear, that's Eastern time.
Yeah, Eastern time.
But that's Eastern time. So I would say the same. We want to trade in periods of higher value because we're going to get the most out of our money. With low volume times, the premium and your contracts can get eaten up. But high value and high volatility, things are more liquid. You can easily get in and out of trades, which we're only trading very liquid stocks. But in terms of higher value and higher volatility makes increases the premium prices. So we're able to get in and out of trades. So those same times, like 9:30 to 11:30, and then come back during power hour. But of course, if the opportunity presents itself during the middle of the day, around some news or around your levels or anything like that, then you can always make a trade as well. So yeah. So okay. So we gave out a lot of options, information. All right.
Yeah.
Now, for sure. So for people who may be a little bit afraid or uncertain or feel like they need that bit of encouragement to get started, what would you say to them?
Well, when you were a baby, you had to crawl before you started walking, right? You didn't know what you were doing at that time. When you started riding a bike, for those that ride bikes, you had to fall a couple of times. For those that went to college, that wanted to learn something new and study something new for their careers, you didn't know your career before you went to college and before you even got a job. So you always have to start somewhere. You got to put in some time, you got to put in some work, some effort and action, and you got to be consistent. So you always got to start somewhere before you even do anything. Whether you try a new meal, cook a new meal, try on some new clothes, you never know what the outcome is going to be, what people are going to say, how people are going to receive it, or how they're going to like it, right? But with trading, it's the same thing. You gotta really walk before you crawl, and then crawl before you run, and then or crawl before you walk, and then you gotta run. So pretty much just to say that, you just gotta start somewhere, regardless of what it is, whether it's like us, how we started off with a ebook or course. You got to start somewhere, and you got to make mistakes. That's really like one of the only ways. I don't want to say the only way, but one of the many ways that you're going to grow and learn how to do what you want to do in this life. So these mistakes that you make, they become lessons, and those lessons are essentially what's going to make you better at what you do.
That's a great point.
What do you think, my brother?
Every major lesson is a bigger blessing. right? That I like to say. The more you learn, the more you'll be able to, the more money you'll be able to make. The more you learn, the more you earn. So I definitely agree that you have to get started, right? But get started in a way that makes sense. Study, learn, ask questions, get around people who are doing what you want to do, and find people you can learn from. You don't have to learn just from one particular person, right? Find a mixture of people that you can learn from. The most important thing is to absorb the content, learn at your own pace, then start to practice everything that you learn, right? Put your systems in place, and then you can start, really trading and making this money. So that's my advice.
I love that. I love that.
So this concludes this episode about options. My billionaire brother, any closing remarks you want to give to the people?
Yeah, thank you for tapping in. If you guys have any questions, feel free to ask me or Dame. You can follow me on Instagram at Live Life with Tola. That's LIVELIFEWITHTOLA. And you can follow Dame, my billionaire brother, at Dame Bond TM. That's DAMEBONDTM. Please do not follow any other pages. There are a lot of people that are making duplicate pages of us and scamming people. So please be aware. Also, please like, share, comment. And if you guys want us to ever go over a topic about investing, real estate, whatever it may be, feel free to let us know so we can go over the topic for you guys. Peace.